Welcome to Candlestick Charts. This is lesson 2. In this lesson, you will learn how to build a candlestick chart. You will learn where the close, the open, the low, and the high go. You will also learn how to interpret a series in order to look at trends and maybe about where the market is going. You will watch a short video that will help you with this. And then finally, we will practice making a candlestick chart from some data. Here is our video. This runs about 5 minutes, and you'll want to be prepared. You will want to take some notes with you because you will be getting 3 different common bearish trends and then 3 different common bullish trends. And you'll want to take some notes so that you can identify these trends when you see them in a chart.
The Japanese candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to 2 simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and 1 or 2 tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish engulfing. The bullish engulfing consists of a red candle followed by a bigger green one, which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, it's likely that the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, and a shorter upper shadow, or no shadow at all. The hammer is usually a clear indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, you could always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning doji star. This pattern appears when there is a slight market movement and consists of 3 candles, a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that mean you can sell. Bearish engulfing. This pattern is the opposite of bullish engulfing. A green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for another, smaller red candle to form and confirm the dark cloud cover. Shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point, may start falling instead. See? Reading Japanese candlestick charts is not rocket science. Just make sure to observe your charts carefully and you'll soon learn to spot patterns as they form.
And that was our video on candlestick charts. So hopefully you took notes on the three types of bullish behaviors. There was the bullish engulfing, the hammer, and the morning doji star. And then there were three types of bearish behavior: the bearish engulfing, the dark cloud cover, and the shooting star. But we were going to look at some of these patterns in the next couple of slides. Okay, let's answer these questions. Explain the difference between the market action on September 8th compared to September 9th, shown in the candlestick chart for this time period, September 7th through September 11th. Okay, so here's September 8th. We have a green candlestick, and here's September 9th. We have a red one. If you followed the video, then you know that a green one means that we closed at a price higher than what we opened, a rising price. Whereas a red one means we closed at a price lower than what we opened. So the action means that our price is going down. Let's look at B. What was the approximate difference between the highest price and the lowest price for the week? Well, the highest price will be on a green candle, and the highest price is going to be around here, just above 39.5. We'll just call that 39.5. And our lowest price will have to be on a red candle, because our close would be at the bottom. So that would be down here, somewhere between 37.5 and 38. So maybe we'll call this 37.8. If that's the case, then the difference between 39.5 and 37.8 would be the difference between the highest and the lowest price for the week. All right, let's look at our patterns. This is Apple. And these candlesticks represent one day. So it represents the high and the low, as well as the close and the open for each day during this time period. What do you think this pattern represents? Here we have a green upward trend, and then we have this big red candlestick. So pause for a minute, look at your notes, and try to predict what that pattern is. Hopefully you noticed that that was the bearish engulfing, where the red candle engulfs this green one. That indicates we're about to have a downward trend and it's perhaps time to sell. And then you can see here that we do have a downward trend. All right, how about this one? This little tiny red candlestick here. What do you think is going to happen here, and which trend is this? Well, hopefully you said hammer, because we have an open price and a closed price that's lower, but it's small. We have a small body, followed by a bigger green body where the open price is lower than our closing price. This is called the hammer. How about this one? This is Microsoft. What does this look like? This should look familiar, but pause and think about it. All right, well, once again, we have bearish engulfing. we have an upward trend followed by this red candlestick that engulfs the green one. This is bearish engulfing. In other words, it means we're shifting from a bull market to a bearish market. Okay, how about here? What do we have here? Well, here we have bullish engulfing because in this case, we had a downward trend, but now this green candlestick encompasses the body of the red one. That's bullish engulfing, where our open is down here at the bottom and our close now is much higher. Look at a couple more. Here's Walmart. Do you recognize this little cross? It's a candlestick, but because it has very small body, almost a non-existent body, remember we call this the doji. So this is the morning doji star, which represents a bullish trend. And you can see that once we have this, we have a red, a downward candlestick, followed by the doji, followed by the green upward trend candlestick. So we did move upward. However, this is why it can be difficult at times to interpret candlestick charts because there's sometimes a lot going on and it's not quite as simple as the 6 trends that we saw in the video. But it can give you a small, short view and help you to make some good predictions. All right, how about this one down here? Well, this, once again, illustrates the hammer. Let's look at General Electric. Here we have an upward trend followed by this bigger red candle. This is the dark cloud cover. Remember that the dark cloud cover either opens at a new high or at the close level of the red one that preceded it, or of the green one that preceded it. What about this one here? It's kind of hard to tell. So what we do know is that it's changing from bearish to bullish. Let's look at constructing a chart. Here's a bunch of different stocks: Google, Microsoft, Oracle, Apple, and then I believe this might be Intel Corporation. What we have here are some minimums, the open, the close, and some maximums for the day. So what I want to do is construct a candlestick chart showing each of these different companies. Well, remember, it's a little bit like a box and whiskers plot in that the shadows or the tails represent the min and the max, whereas the body represents the open and the close. Now what we need to do is analyze the open and close. In this case, the open is lower than the close. If that's the case, we know we have a green candlestick. So let's see what that looks like. So here is Google's. Our open was right around here at 100. Our close was here at 110, and our minimum was 90, our maximum was 120. It's as simple as that. Here's Microsoft, same thing. Open is lower than the close, and then we have our min and max. How about Oracle? It looks like we have the same type of candlestick. It's going to be green because our open is still lower. Same with Apple. Our open is 30, our close is 40. Notice that our max was up here at 50 and our min down here at 20. How about Intel down here? Well, our open is 45 and our close is 35. So we went down. This is going to be a red candlestick. Notice that now we show our close here at the bottom at 35 and our open at the top at 45, indicating a downward trend. Okay, hopefully this was helpful, and at this point you should be able to construct a candlestick chart as well as to see some trends and data when you look at candlestick charts, specifically those 6 that we talked about. But if you see a trend that's happening and you're not sure which one it is, you can at least tell if we're entering a bullish market or a bearish market with that stock.